What's going on, everybody? Michael Silva here. You're watching the Stock Market Brief Show. Today, we have some important data to go over. We're going to be covering what's going on over here with high yield relative to the S&P 500. We're going to update you on some signal charts, talk about how we're going to be approaching the market. We do have some data that will be coming out, which will touch on what that is and how the seasonality might play a role in all of this on today's Stock Market Brief Show. If you don't subscribe already, make sure to hit that subscribe button and smash the like button is greatly appreciated. That's a thumbs up. We're going to get right into it today. Now, if you're new here, well, first, welcome to the show, but we use these daily expected moves. The daily expected moves are not just random levels. This is a calculation based off of implied volatility in the options market, right? Looking backwards on a chart, we can see what future volatility is. You may have heard of the average true range, or ATR. Well, looking forward for future volatility, you can look at implied volatility and do what's known as an expected move. Now, if you think of expected moves as a distribution curve, 68% of the time it closes within that one standard deviation, and 95% of the time it's going to close within two standard deviations. Today, we opened outside the daily expected move, and then it pushed itself down to where? The two standard deviation area. Now remember, 95% of the time it closes within this range. So early on in the trading session, we already moved. And this right here is where emotions run wild because the options market was not prepared for this. Now look what took place. We U-turned right back up through that daily volume weighted average price, and we made ourselves back within that standard deviation because 68% of the time, price does tend to close within it. Okay, we're going to be updating you on these levels and how to approach this market here very soon. We're going to take a look here now, though, at pre-election year seasonality. This is a chart by Almanac Trader, and I love his seasonality charts here. You can see the dashed lines are known as pre-election years, which we are in, and then we have the regular years, the solid lines. And as you can see, typically during pre-election years in August, if you're looking at this chart and you're like, what does this chart even mean? This is the percent change right over here on this axis. And then over here, we have the amount of trading days. You'll see this orange box over here because that represents where we're going to be. Tomorrow, we're going to be trading the 7th trading day of the month. And as you'll notice, this is typically where we start to find somewhat of a bottom in a pre-election year seasonality form, where it kind of moves itself up for a few trading days, and then it kind of comes down back again. Overall, the month of August, I mean, it's not the greatest trading month, but if you were watching prior videos, we've shown that in the middle of July, this is typically where seasonality takes hold, and you see some pullbacks, and that's what we've been seeing. So from a seasonality perspective, it says that we very well might see some strength potentially here for a couple of trading days. Now, we do have a lot of earnings coming up. We have stuff like Disney after the close tomorrow. Baba would be another big one coming before the open. And then Wednesday, tomorrow morning before the open, we have Roadblocks. A bunch of other names here. I'm not going to go through them all. But the big thing that can really change these markets up right now is the data that's going to be coming out Thursday, August 10th, an hour before the market opens up. And that is the inflation data. After that, we're going to have Friday's PPI data and Michigan consumer sentiment numbers. Now, these things can have a toll on the market when it comes to volatility. And when I say volatility, it means plus or minus. People don't always understand that. Things can get volatile to the upside. Things can get volatile to the downside. When we take a look at the book map, these levels are still here, which is a little bit of a concern, meaning that the longer we stay here, they could potentially act as a magnet to suck price back into this area. So we'll see really how this changes. It's been now over a week, could be now going on 2 weeks with this, pretty large level of liquidity here, 1,700 plus contracts leading into the CPI report. So how do we go about playing all of this? Well, I want to first point out this chart. This is the 15-minute chart of the S&P 500, and you'll see purple circles. Okay, pink circles and a purple line. The purple line is the 130 period moving average. This is the 5-day moving average. If you know this, there's 1,950 minutes. Right, 1,950 minutes in a 5-day trading period. So you take 1,950 divided by 15, out comes 130. Okay, so that's why we're using the 130 period. And all we are using this as, it's not necessarily a level of support or resistance. It's to show us what the trend is. And as you can see, it moves flat for one area. This could be a period of accumulation. Then we go into a markup phase. The markup phase is when the line goes up. And as you can see, price was holding, it came down, it bounced up. Even when it came down here, the line was still inclining. And when price gets below it, if it's inclining, you want to be bearish, but with caution, right? Because it could very well snap back up. And it did. Okay, then we got this big break here, and this is where the line started to actually decline. So now when price gets below it, right, when we're below it, okay, it's bearish, and the trend is now bearish too as well. So in order to be bullish in this time, you want that line to start flattening out, to go neutral, like an accumulation phase, or just, a consolidation. And instead of going back down to decline, you'd want that line to start ticking up. And in order to do that, well, we would need days to come off the data, right? So we have 1, 2, 3, 4, 5 trading days. So we're going to lose this day, and then we're going to add a new day tomorrow. So if this price comes down and starts moving up, we're going to start losing this data as time goes, which will help flatten out this line to start moving it back up. Now, I want you to pay attention to the amount of volatility that we've been seeing here. So first, you can see we get these big rips up, people get happy, then it gets rejected at that purple line, and we rip up, people got happy, got rejected at the purple line, came back up. Is it going to get rejected? I don't know, but just take a look at where prices come from. It came from 445.60 to 449.20, basically in a straight shot. So in order to be more bullish about this, right, you'd want to see price digest this a little bit, and you'd want to see what price does after a pullback or consolidation. Is it going to start seeing strength where you have a now higher low? That would be a positive sign, and then potentially breaks out. That could be a potential sign. If I'm looking at this from a just technical perspective, we do have a positive divergence in the RSI, positive divergence in the price momentum oscillator. But remember, if price gets outside of it, we still at a declining 5-day moving average. So say if we gap way up here, and people might FOMO into it, but hey, price might come right back, and then it might consolidate, pull back, and do something like that from a bullish perspective. Or people aren't paying attention to this move, they want to chase it, and then we gap back down, and we just see another constant move of volatility. Now, what can we pay attention to as far as levels go? So 445, the low of the day, basically is broken. Pay attention to this gap fill here right at around 443. If that fills, that little window may act as a level of support. So it'd be a level of interest to pay attention to see what price does if it comes down to that level. Other than that, like I said, I wouldn't be chasing up in here. I'd be waiting to see what price does after its pullback and or consolidation if you missed that gigantic run. If I update you on the daily expected moves, we got 451.31 to the upside, 446.19 to the downside. And as you can see, we are also below that quarter-to-date anchored VWAP. So we have levels of confluence here, people. A big, strong move into levels of resistance. We have the month-to-date anchored VWAP, the quarter-to-date anchored VWAP, and the declining 5-day moving average. So would you be shocked to see price go like this? I would say, no, I would not be shocked to see price move like that. Would you be shocked to see price go like this? No, I wouldn't. Why? Because you don't chase up here. You wait to see if price consolidates, puts in a higher low, and then you could play from a more strategic standpoint from a bullish direction to see if this starts flattening out. Okay, but if you're entering long into a very strong move and it comes down here, right, that might scare you out to the point where it comes right back and then does it, and then you're like, forget it, and then it might take off. Or might pull back, you get out, and it might continue to sink down to the lower daily expected move. That's always a possibility too. But remember, the market moves between expansion and contraction. That means price is wide, right? It moves, strong moves. Then it starts to contract, so it gets to tight again. And this is what offers up the better risk to reward and volatility in your side. So if price were to flag right here and all of a sudden break out of this flag, it will allow for an entry here on breakout on strength, right? It pulls back, you buy on strength, and then it has a stop loss under this prior swing low. Maybe you want change up the position a bit. Maybe you're like, I'll take 50% stop here, but then I'll do a 50% stop below this low just in case if I'm wicked out, but then it starts to head higher, I'll have a piece. Okay, that's always a possibility. As it stands from a bearish perspective, if it holds, then you got to just continue to follow the lower highs and lower lows to play to the downside, okay? Now, when I'm looking at this from a signal perspective, the BP-INFO chart, this is the bullish percent index for the technology sector. This is getting oversold conditions. It's still relatively high reading when you look back, but it is in oversold conditions, meaning some of the big names could potentially bounce. The big names hold a big market cap. We talked about that yesterday. I'm not going to talk about it today. And then the BP NDX too. No surprise there. This is a tech sector or technology. The NASDAQ 100 is more tech focused, and it's a bullish percent index for the NASDAQ, and that is moving into the oversold condition as well. And then I want to follow on this chart here. This is known as, smart money, right? HYG, the high yield or bond market, is considered, smart money, where the equity markets, those are considered the dumb money. I don't know why, but that's what I've heard. And sometimes what you'll notice on these smaller time frames is you'll see things like high yield lead the way. So for example, this right here put in a high and then a lower high. And at that time, you were putting in a high and a higher high. So dumb money, right, was going up and putting in higher highs, while the smart money was saying, no, something's off here. And as you can see after that point, well, price sold off on the SPY and then continued its way down. Now I'm pointing this out because it works in reverse as well. Sometimes, right? You have dumb money getting all scared right here, right? Putting in lower lows, right? Potentially wedging right here. And then you have the smart money, right, actually going up. So you can see a low, a higher low, a higher low, a higher low, and even broke that high right here, which we haven't even done on the SPY yet. So is this telling us, hey, is the SPY going to come and retest these highs and potentially fill this gap or try to come back here? It's a possibility, and this could be an early indication, just like the negative divergence was an early indication as well. So that's something to pay attention to, especially when you pair that with like seasonality, how things are getting oversold, right? But when you tie it all together, what is the overall chart telling us? The chart is telling us it made a strong move. You got to be patient, wait for it to consolidate, contract, gives us a better risk to reward. So if you do get stopped out, it's not losing a large sum. It's all about managing risk. That's how you do good. If you want to screenshot this is the daily expected moves, what I share with my Patreon group, Discord group every day. I didn't go over the Qs or any other products, so I figured I'd share this with you. You got upper levels here, lower levels, and then if you want to put the 2 sigma levels on your chart, they're right there. That's all I got for you. See you later.